Are you looking for stability in the ever-changing retail real estate market? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Today, we're diving into CT Real Estate Investment Trust's impressive second quarter performance in 2025, which has positioned them as a compelling case for retail real estate exposure. According to Eli Grant's article, CT REIT achieved a 3.7% revenue growth, bringing in $149,800,000. This growth was largely driven by Canadian Tire lease escalations and strategic acquisitions. CT REIT's strategic moves include a significant $200 million redevelopment of Canada Square in Toronto. This project involves creating 680,000 square feet of leadership in energy and environmental design certified mixed-use space with 20-year anchor leases. It's fascinating to note that the REIT maintains a 99.5% portfolio occupancy, with 93% of its gross leasable area leased to Canadian Tire Corporation. Eli Grant highlights that CT REIT's strategic co-investments and a 7.55% yield on new projects showcase its resilience in the retail real estate sector. Their focus on environmental, social, and governance-aligned urban development ensures they remain relevant and profitable as cities evolve. In terms of capital allocation, CT REIT's recent $200 million unsecured debt issuance strengthens its balance sheet, which is rated BBB by Morningstar DBRS. This prudent debt management is crucial in a rising rate environment. Their partnership with Canadian Tire Corporation is more than just a landlord-tenant relationship. It's a symbiotic alliance that ensures alignment of interests. CT REIT's Q2 performance and strategic initiatives present a high-conviction opportunity for investors seeking consistent cash flow and disciplined capital deployment. With a 2.5% distribution increase in July 2025, CT REIT not only offers income but also growth potential, making it a standout in the retail REIT space. Next, let's shift our focus to an intriguing transaction in the retail real estate sector. According to Kevin Parker, JLL Capital Markets has facilitated the sale of a substantial 10-property open-air retail portfolio that spans across Florida and South Carolina. This portfolio, which covers approximately 1.04 million square feet, traded hands for an impressive $395.5 million. The portfolio's appeal is underscored by its impressive 91.6% overall occupancy rate. Located in affluent trade areas, these properties benefit from strong demographics, with an average household income of $101,152 within a 3-mile radius. The properties are strategically situated in desirable southeast markets, which include Plantation Promenade in Plantation, Florida, Sawgrass Square, Ryan, IY in Sunrise, Florida, and the Promenade in Poinciana, Florida, among others. JLL represented the seller, PGIM Real Estate, in this transaction, while 11 North Partners and Bain Capital were the acquiring entities. Danny Finkel, Senior Managing Director and co-lead of JLL's United States Retail Capital Markets team, highlighted the unique opportunity to acquire a portfolio of this quality and scale in such sought-after markets. This transaction demonstrates the robust investor demand for top-tier retail centers with strong anchor tenants and stable occupancy. Brian Harper, founder and managing partner of 11 North, added that this acquisition allows them to embed their platform in thriving communities that are experiencing significant demographic shifts, including lifestyle migration and an aging population. This aligns with their strategy to deliver attractive risk-adjusted returns by unlocking value across retail verticals, including real estate ownership and debt. This transaction serves as a testament to the dynamic and evolving nature of the retail real estate market in the Southeast United States. As we draw parallels with the market in Ontario, Canada, particularly in regions like Kitchener, Waterloo, London, and Cambridge, it's evident that similar demographic shifts and strategic investments can yield substantial opportunities for investors on both sides of the border. Australia's commercial real estate market is witnessing a significant resurgence in offshore capital. According to Lucas Cacchioli, foreign investors have been responsible for 51% of the transaction volumes in the first half of the year. This influx has resulted in a remarkable $6.7 billion, or 10.3 billion Australian dollars in deals. This renewed interest from foreign investors highlights a growing confidence in Australia's commercial property sector, driven by its strong economic fundamentals and stable political environment. The appeal of Australia's market is further bolstered by its position as a gateway to the Asia-Pacific region, offering strategic advantages for global investors. In comparison, the commercial real estate markets in Kitchener-Waterloo, London, and Cambridge, Ontario, continue to attract domestic and international interest, particularly in the multifamily and industrial sectors. These regions are recognized for their robust economic growth, technological innovation, and strategic location within the Greater Toronto Area. While Australia's market benefits from its proximity to Asia, the Ontario markets leverage their connectivity to major North American cities and trade routes. This cross-border relevance underscores the importance of geographic positioning in attracting foreign investment and fostering economic growth in the commercial real estate sector. In Johnston County, North Carolina, a major commercial development is poised to significantly alter the retail landscape. According to Ben Tobin from the Triangle Business Journal, this expansive project could potentially attract high-profile retailers such as Target, Costco, and Chick-fil-A to the area. This development is not only expected to enhance the retail offerings in Johnston County, but also to serve as a catalyst for economic growth in the region. The project, which is still in its preliminary stages, aims to capitalize on the growing demand for retail spaces in rapidly expanding markets. The presence of major retailers like Target and Costco is anticipated to draw significant consumer traffic, thereby boosting local businesses and increasing job opportunities. This development reflects a broader trend of retail expansion in burgeoning towns across the United States, where strategic investments are being made to accommodate population growth and evolving consumer preferences. Johnston County, with its favorable economic conditions and increasing population, presents an attractive proposition for retailers looking to expand their footprint. In comparison, similar trends can be observed in the commercial real estate markets of Kitchener-Waterloo, London, and Cambridge, Ontario. These regions are also witnessing a surge in retail and multifamily developments, driven by strong economic fundamentals and a growing population. The strategic positioning of these Ontario markets within the Greater Toronto Area further enhances their appeal to both domestic and international investors. The cross-border relevance of these developments underscores the importance of geographic positioning and market dynamics in attracting investment and fostering growth. As Johnston County positions itself as a retail hub in North Carolina, the Ontario markets continue to leverage their connectivity to major North American trade routes, highlighting the interplay between local market conditions and broader economic trends. In a significant move for the electric vehicle sector, Tesla has expanded its presence in India by leasing nearly 51,000 square feet of commercial space in Gurugram. This comes on the heels of their recent debut in Mumbai. According to HT Real Estate News, Tesla India Motor and Energy Private Limited has secured this space at Orchid Business Park on Sona Road, Gurugram, with a monthly rent starting at 40.17 lakh rupees. The lease, which commenced on July 15, 2025, is set for 9 years, marking Tesla's second commercial space in India. The space, leased from Garwal Property Private Limited, will function as a service center, warehouse, and retail outlet. The lease agreement includes an annual escalation of 4.75%, reflecting a strategic investment by Tesla to enhance its service capabilities and retail presence in the region. The commercial lease details reveal a structured rent increase over the years, starting from 40.17 lakh rupees in the first year and escalating to 58.22 lakh rupees by the 9th year. This structured approach underscores Tesla's long-term commitment to the Indian market. Additionally, Tesla plans to open a showroom in Delhi's Worldmark Mall, Aerocity, further cementing its footprint in India's rapidly growing electric vehicle market. This expansion is part of Tesla's broader strategy to tap into emerging markets with high growth potential. In a broader context, the commercial real estate markets in Kitchener-Waterloo, London, and Cambridge, Ontario, are also witnessing similar trends with increased interest in industrial and multifamily developments. These regions are leveraging their strategic locations to attract both domestic and international investments, much like Tesla's approach in India. As the electric vehicle industry continues to grow, the demand for commercial spaces that support service and retail operations is expected to rise. This trend is not only evident in India but also in Ontario's markets, where the focus on technological innovation and sustainability aligns with the needs of modern enterprises. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.